All right, since we're on the topic of assets and liabilities, I just wanted to throw in this little thing about duration. Duration is the concept of matching your maturities on assets and matching maturities on liabilities. So, for instance, if you have, if your company has current assets that are that size and long-term assets that are this size, you generally want that graph to look the same on the liabilities side. Okay, so the idea is that you have this much in current assets, you basically want your percentage of liabilities to match up. This is called a common size balance sheet. It's kind of a graph to show you how appropriate your debts are in terms of their maturity. Are they matching up to your assets? So this line on the liability side, you want to be down there, and you want to match proportionately your current liabilities to current assets, and conversely your long-term liability, your long-term assets to long-term liabilities. You want your long-term assets to be funded by long-term liabilities, and you want those to be things like equipment and real estate, and you want accounts receivable and inventory, things like that, to be funded by short-term liabilities, and that's usually in the form of a line of credit, which is on the current section of the balance sheet. All right, so we talked a little bit about balance sheet composition and why this is important to lenders. Let's talk about sales trends. Sales trends, obviously, I think are at the root of most turnaround issues. Something has happened in the sales trend that has not been favorable to the company, and these are very difficult things to be able to navigate on a month-to-month basis. And sometimes you just find your top line diminishing and diminishing before you can really do anything about it in the G&A category or even in the gross margin. Okay, so here's a few thoughts to just summarize what we've been talking about financial performance. So we talked about the P&L and the balance sheet, certain ratios. So first thought is it's not just about the history. Bank lenders tend to be backward looking. They're interested in what's been happening. They rely a lot on the financial statements, which are a measure of historical performance. Whereas some lenders are more forward looking, and so they can tie in the history and what's changing to the prospects for the company going forward. So it's not just about the history, it's also about the outlook. Another thing to think about when it comes to financial performance is that lenders like companies and management teams that accept responsibility. If you get on the phone with a lender, whether it's a bank or a non-bank, and the bank hears excuses and all the things that the world did, they're going to be unsympathetic. But when you take responsibility for your reaction or lack of reaction or just mistakes that were made by the management team, those weigh heavily in favor of a lender buying into what your concept is going forward, because it shows that you're able to be honest about what happened in the past and you're able to take responsibility for it, and therefore you have control of moving the company forward based on the lessons learned. Some other summary thoughts: the P&L is past, okay? The P&L forecast is future. The balance sheet is more of a snapshot in time. I think it's important to look at the balance sheet as a snapshot in time because the lender is going to be looking at your deal at a certain point in time. They need to understand the composition of the balance sheet and what impact their new loan will have on the balance sheet, what your balance sheet composition will look like after they fund, and whether that's the kind of situation that they are prepared to lend into. Another thing to think about when talking about financial performance and looking for a new lender is that risk is going to be a direct proportion to pricing. If you're a risky deal, if you're at the early stage of a turnaround, that's a very high risk situation, you can expect to pay a lot of money. Turnarounds are not cheap, they're expensive, but they are also temporary. Sometimes it doesn't feel good if things haven't gone according to plan, and if you're in workout with your bank, the workout officer may not be the most pleasant of people to deal with on a day in, day out basis, but they're doing their job just the same as you're trying to do your job. So it's important to remember that these are not pleasant experiences, in the life cycle of a business, but they can be temporary. So it is important to remember that turnarounds, while being kind of painful, they are temporary. They're expensive, but they are temporary. And so long as you have the wherewithal to basically be able to suck it up and navigate through a more difficult time in your business life cycle, then you can certainly navigate through the darker times in your business and find the financing that you are going to need to move forward, find the right lending partner. And you'll notice that I haven't really talked very much about pricing in this episode or in any of the episodes that I've been presenting thus far, because pricing is incidental. Pricing is going to be a matter of perceived risk, and it's going to be a function of how much damage has been done and what the outlook for the company is. So it's important to not get hung up on the pricing when you're dealing with a non-bank lender or a bank lender, but more importantly a non-bank lender, because pricing will be all over the board. If you find the right lender, you're going to find the pricing that is right for you. Whether you like it or not, that's a different story, but the pricing is pretty much going to be what the market drives. And in my experience, different situations, when you go to multiple lenders, the pricing is going to come in right about the same, with subtle variations on whether it's fee driven or whether it's interest rate driven. But the bottom line is that if the risk perception is higher, then the market is going to respond with higher pricing. All right, finally, let's wrap up with just a short summary on size. We've talked about this in a couple of early episodes, but the fact of the matter is that you can talk to 100 lenders who might be able to do your deal, but none of them may be in the right size. So in addition to finding the right lender in terms of composition of the balance sheet and the historical performance of the company, it's important to remember that they all have their own size preferences, and there are a variety of reasons for it. Number one is the size of the lender itself. So asset size, it dovetails with collateral. How much collateral do you have to offer? What type of collateral? Where is the collateral concentrated in? Is it current assets? Is it long-term assets? Is it AR, inventory, equipment? Just what is the collateral and how big is it? Also, another thing to look at is revenue size. A lot of lenders will take the loan request and compare it to the revenue size of the company, and they may come back and they say, this fits well within the revenue size of the company. A $5 million loan request for a $15 million company is entirely reasonable. And there are other businesses that don't work that way. Equipment rental businesses are one great example of how the borrowing need and the revenue size can be roughly the same. Bankers don't tend to like that, but the fact of the matter is that if you rent out equipment, then your inventory doesn't turn, it just renews itself. And as a result, you may have a lot of debt on that equipment, and that debt may be roughly equivalent to the revenue size of the business. Third parameter with regard to size is EBITDA size. EBITDA is on the margin, so when sales are declining, EBITDA will decline faster. This is always a problem when you're looking for a lender, because lenders sometimes base their loan criteria on the EBITDA size of a company. And then the other and most important aspect of size has to do with the transaction size. How big is the loan that you need? This probably should have been number one. So when you're looking at a population of lenders and you have a certain size deal, know that your deal is not going to be the right size for every lender, and you're going to have to kind of have enough data to know which lenders are in a position to do your loan based on the size request and which lenders are not. So again, thank you for watching. I appreciate you being here for this episode on navigating the world of alternative finance. My name is Kevin Pierce. I'm the president and CEO of Caldez Financial. Please join me on the web at www.caldezfinancial.com, or shoot me an email with any feedback that you've got to kevin.pierce@caldezfinancial.com. Thanks for joining me, and we'll see you next week.